Nothing mixed about the markets. It looks like a one-way street at this juncture with both global and domestic cues blending nicely for India and hence taking on the all-time highs yet again. But where do we go from here? What kind of targets can we set for the Sensex and the Nifty? What should be the sectoral churn? For all those, we have advanced our market master, Sanjeev Prasad, Senior Executive Director and co-head at Kotak Institutional Equities, joins us now as a market master for the day. Good morning, Sanjeev. Thank you very much for joining us. The market quite clearly has claimed the old highs. What is the sense you are getting that an Indian outperformance looks set for another 6 to 12 months?
I guess it could continue for the next several years if we do the right things. You look at it this way, at this point in time, everything is falling in place for the country as a whole. On the one side, you are seeing a remarkable improvement in the macroeconomic parameters led by lower food prices and some of the self-help efforts taken by the government in terms of diesel deregulation, restricting coal imports, etc. So if you look at the macroeconomic parameters, suddenly you have seen a big improvement in current account deficit, which is well below 2% now. Compare that with any of the other emerging markets, especially the other members of the so-called Fragile Five Club. Most of them are above 3%. In some cases, like South Africa, it's more than 5%. Turkey, it's something like 6-odd%. So clearly, India has distanced itself from many other emerging markets in terms of the improvement in the macroeconomic situation. If you look at the fiscal deficit numbers, give or take, I think the government will be able to manage the 4.1% number for this year. And I think over the next 2 years, as we see further reforms in terms of direct cash transfer schemes being implemented, GST coming in place by April 16, I am reasonably confident that you could see fiscal deficit declining to maybe 3.5% by the fiscal 2017 year. So again, a big improvement as far as the fiscal situation is concerned. Inflation is really declining, and I hope at some point in time the RBI acts accordingly in terms of reducing the policy rate. So that's one part of the story where you're seeing a remarkable improvement on the macroeconomic side. On the other side, after let's say the first 3-4 months where you did not see too much of announcement on economic reforms by the government, the focus was more in external affairs. Over the last 1 month, you have suddenly seen a huge rollout of economic reforms. Many of them are fairly bold. Let's see whether the parliament obstructs some of the measures like opening up the coal sector for private sector, commercial mining, etc. But I think the government has got the focus right in terms of doing big things now. So put all these two things together, you are certainly looking at a situation where India's GDP growth could accelerate to maybe, let's say, 7% by 2017. Interest rates could be coming down. So, you have a pretty good situation where we could continue to look good and continue to grow quite fast, which will translate into earning numbers for the next several years now.
Hi Sanjeev, morning. Since you said the word earnings, I'm going to ask you about a lot of good quality numbers that we got in the last couple of days, whether it's financials like ICICI and Yes Bank, whether it's IT names like Tech Mahindra. What are your top picks now from what you've seen so far?
Yeah, I really don't look at one quarter numbers to decide on my, let's say, portfolio for the next 12 to 18 months. The focus is on what I was saying is the themes which I was harping on earlier, which is economic recovery and lower interest rates. So if you look at the recommendation which we have at this point in time, it's been pretty similar through the course of the year. But we are really pushing private banks in a big way, as also the automobile sectors, both of which are big beneficiaries of an improvement in the GDP as we expect over the next 2-3 years, and for the next several years, I would say after that. And at the same time, we would see a short-term decline in interest rates. Our call is maybe April, but it could happen even in February. Let's see what readings come out for CPI inflation for the Jan to March period. If they are in the range of 6.5% or lower, then I think the RBI may respond earlier than what was the view, let's say, a few weeks back. So very overweight, I would say, on private banks and automobiles at this point in time.
We just got Titan earnings. It used to be the gold standard in terms of discretionary sales stocks until a few months back. You think the shine is over now?
See, this quarter's numbers for Titan are, very convoluted because it has a lot of things which are one-off in nature. So I won't really focus on that. But if you look at, keep aside the gold part for a moment. If you look at the water segment, that seems to be doing reasonably okay. But broadly speaking, the valuations are very rich at this point in time. So we have downgraded the stock to a sell rating now.
Just to continue with your older theme, you spoke about automobiles. What's the pecking order there?
We like Maruti and Hero as far as the domestic cyclical recovery is concerned, and Tata Motors continues to be one of our topics.
Okay. What about a name like Bharti? Post the earnings, what would your analysis be on how to approach that stock? Because since the start of the year, it's underperformed the rest of the market.
The Bharti looks reasonably fairly well at this point in time. The domestic part of the business seems to be doing reasonably okay. But if you look at the overseas business, both Africa and South Asia seem to be struggling a little bit, and that's what came out in the second quarter numbers also. So we are more positively inclined towards Idea at this point in time compared to Bharti. We are reasonably positive that the irrational price competition which was there in the market for the last few years, that seems to have gone away. Hopefully we will see some improvement in pricing power coming back to the three major companies, that should result in some improvement in the revenue per minute going forward. Also, data volume has been going up pretty sharply on a quarter-on-quarter basis for the last few quarters, and that will continue for the next several quarters, I would think. So if you have to play the domestic price rationalization and data volume story, then I would look at Idea more favorably compared to Bharti at this point in time.
Okay, Sanjeev, would you believe that mid-caps will give more outsized returns in the next few months and quarters simply because they lag more? And how would you look for stocks over there? Let me start with the more economy-dependent stocks, some infrastructure stocks like IL&FS Engineering or NCC are ones that have not hurt their balance sheets. How would you, can you guide us as to the stocks that you like in that space?
Oh, okay. I don't really cover those companies. So, as a house, we don't cover those companies. So I don't have much of a view specifically on the names you mentioned. But broadly, if you look at the industrial infrastructure space, I hope at some point in time, the investment cycle starts falling in place. I think it's still 2 to 4 quarters away. The government is doing the right things, in setting in place the foundation for investment in terms of addressing some of the issues which have plagued investment, whether it is, the approval process which has become a lot, faster and transparent now, some clarification coming on the auction of resources, etc. Land reforms, hopefully we'll see some movement over there in the winter session of Parliament. Labour reforms, some steps have been taken. So hopefully, going forward next 2-4 quarters, you start seeing some revival in the investment cycle. My worry over here is that, the market seems to have run well ahead of itself in terms of discounting some of the earning numbers of these companies. So when I look at the valuations of the industrial infrastructure names, a lot of them seem to be looking very expensive, even assuming a big recovery in earning numbers going forward. And my worry is over the next, let's say 2 quarters, we could see some disappointment. You look at ABB's numbers, for example, the stock is trading at some completely crazy valuation at this point in time. So clearly, we are assuming a big recovery in earnings over there. But every quarter, the numbers come well below our estimates. And at this point of time, the backlog has also declined. So as of now, we are not seeing really any recovery as far as the industrial investment cycle is concerned. So, to stretch this in terms of suddenly translating to a big recovery 2 quarters or 4 quarters down the line, I think seems a little bit far-fetched at this point in time.
That's an interesting point you make, Sanjeev. Is the market also to some extent discounting the outcome of the next 2 triggers that we have, the winter session of the Parliament and the budget?
I would think so. Obviously the valuations are not very cheap anymore. If you look at the broad markets already trading at 16 times on a 12-month forward basis. On March 16, the BSE 30 is somewhere about 15 times now. So the scope for rating, I would say, is somewhat limited. But keep in mind the fact that this market could continue to run ahead of itself in terms of when people start discounting, let's say 2017 numbers. And if you see the two triggers which we talked about. One is, domestic reforms continuing, and the second one is, some softening as far as the monetary policy is concerned. Then I think this market could, just continue to, pull forward earnings in that sense. If I look at 2017 numbers, for example, which logically should get discounted somewhere up in the, let's say, March to June 2016 period. If I do the simple math of 16 times on March 17 earnings, the index logically should get about 32,000 sometime, let's say, in March to June quarter. But having said that, if the pace of reforms continues, I won't be too surprised to see, some of these valuations getting discounted well in advance of, when they should be logically. So that's the thing. If the domestic reforms continue in a bigger way, then, the earning numbers will just keep on getting pulled forward.
Okay, I still want you to identify some mid-caps for me, the non-Sensex, non-Nifty variety.
Oh my God, you're really putting me on the rocks over here. Okay, here goes. So if you look at, let's say, alphabetically, auto sector, I will look at Apollo Tyres, given the fact that it would benefit from lower rubber prices, which is playing out to some extent. Stock is still cheap, it's somewhere about 10 times on 2016 EPS. If I look at mid-cap banking space, we'll actually like most of the smaller private names, whether you look at CUB, KDCB, Federal Bank, ING, we actually like all those names. On the NBFC side, our big push has been in LIC Housing Finance. So the stock has done well, but I think given the thrust on housing in the country as a whole, given the quality of housing, the population growth, I think housing will be a big theme, and accordingly, you can play it through housing finance companies such as LIC Housing Finance. Valuation is still okay, actually. It's trading at about 1.6 or 1.7 times in March 16 basis, so still looks okay. Then if you look at the consumer staple names, we actually like a whole host of names over there, starting from Britannia, Marico, etc. The stocks have done very well over the last, 6 months. But having said that, I think they can still benefit from lower commodity prices going forward. Particularly, Marico could be a big beneficiary, as in when you see a correction in copra prices. Copra is actually 1/6 of the turnover of the company, so you can see a big improvement in gross margins over there. So those are the names we are playing. Some of them which could benefit from lower commodity prices, or some of them which are natural beneficiaries of growth in the economy.
I'm glad I persisted. Thank you very much for that bunch of stocks, both heavies as well as mid-caps, Sanjeev, and thanks for dropping in today.